Holy smokers, folks, this ain't no dang jokers. It's a buy one, get two free here today in this video. 3 videos for me to react to. First one up here. Sectors that lead you into a market peak rarely lead you out of a trough, says SoFi's Liz Young. So we shall hear what Liz Young has to say, and I'll kind of give my perspective on that. Second video to react to in this one. Consumers edging closer to a breaking point, says former Bridgewater chief investment strategist. Bridgewater, I always think about Bridgewater to think about Ray Dalio. Okay, we'll hear what she has to say. And my enemy. Dan Niles. Dan Niles will react to that as the last video. Oh, man, if you know, I don't really like Dan Niles. I don't know why, okay? I usually like almost everybody, and even bears. I usually like most bears, but something about Dan Niles. I mean, he'll come on and right away he's pointing out, oh, I was right about this, I was right about that, I was right about this. And it's like, dude, we don't have time to keep track of whatever you're right about or wrong about. And then just a lot of his points, I just completely disagree with the way he looks at the market, and just like, oh, he bugs me, okay? Like I said, 99% of people, I like him. I really do. Dan Niles, he's just not that guy, okay? Not that guy. So we'll hear what he has to say. I'll react to that one, and I'll try to keep my emotions in check while that one goes on. So I appreciate everybody joining me as always. We are now, oh gosh, we're probably hit 24,000 subscribers in the next, I would say 24 hours or so. So somebody's going to be subscriber 24,000. I appreciate y'all for being here as always. Thank you so much. Also, thank you everybody that supports on Patreon. If you're looking to access the stocks I'm buying and not buying right now, you can check us out on Patreon. We have 800 plus members now on the Patreon, and I always post, whenever I'm making moves in that portfolio, which is every single Friday. Let's get into this.
To, grow their asset management business, which is the very reason why you're bullish on Morgan Stanley over Goldman Sachs. I mean, that's the stock you choose in the group.
Of course, and I've wanted for years. Everyone wants the asset management. Everyone wants the wealth management business right now. It's so incredibly important. You're seeing a lot of the big players going out and purchasing some larger IRAs. So I want there to be a bigger presence on the part of Goldman Sachs, but there isn't right now. And there is, in the case of Morgan Stanley, they've done the right thing, Morgan Stanley. Eaton Vance, E-Trade. 2 fantastic acquisitions. It's benefiting them now. And quite candidly, the reason I'm in Bank of America is for Merrill Lynch. Without Merrill Lynch, where would Bank of America be? I think it would be in the same position as Citi.
Okay, so Liz Young, how do you view...
So, by the way, Goldman Sachs, before Liz Young gets talking about, what she's going to talk about here. Goldman Sachs, do I think Goldman Sachs stock is a buy? First off, I held Goldman Sachs quite, like years ago. It was a stock I did own, okay? I will say this. Goldman Sachs, not a buy yet, okay? It is possible I could buy Goldman Sachs at some point later on this year or maybe next year. The main issue with Goldman Sachs is they're in very much a transition mode right now. They tried to go consumer banking over the past few years, okay? I think it was a misstep on many fronts, right? They lost a fortune trying to do that. You're Goldman Sachs, you have this prestigious brand, and then you're going to just have everybody use your service, including they looked like there was some folks that were starting to use Goldman Sachs different related products that didn't even have good credit scores and didn't even make much money. And it was I think they got attracted to the allure of fintech and what was going on there. And it's kind of like, it would be like if Louis Vuitton just said, we want everybody to be our customers. No, that's not what makes your brand special. Well, the thing that makes Goldman Sachs special is they were always supposed to be seen as they're the smartest in the room, okay? And they got if you're a client of Goldman Sachs, it meant something, right? If everybody can be a Goldman Sachs client, it doesn't mean anything. So Goldman Sachs has made, in my opinion, several missteps over the past few years, and now they got to clean up their mess. But the thing is, with a mess like that, it doesn't happen overnight. It takes many, many quarters, and sometimes it takes several years to clean up that mess. So that's why for me with Goldman Sachs right now, it's not a buy right now. It is one I'm keeping an eye on. Maybe it is down the road.
This space, do you like the financials as, again, we wrap up February and we go into a new month?
Well, so a couple things. First of all, the asset management business, if you look at asset management and the consumer business, and also it's not lost on me that I sit here representing a very consumer-facing bank, right? If you look at asset management, there was likely to be consolidation in the space as ETFs took over, passive management took over. There was so much compression in fees. It's difficult to get that space right and still make money. On the consumer side of things, there's been such a proliferation of fintech. Competition is fierce. also very hard to make money in that space, and this competition over deposits that's going to take place probably for the next year or so until rates actually come down. That being said, I think you do have to separate financials and banks and look at them in different ways. So if you look at just the financial sector overall, still the second cheapest in the index, and I think valuations matter. If you take Berkshire Hathaway out of there, even cheaper, right? Banks, on the other hand, even cheaper than the financial sector broadly. So seems like a good entry point. I would caution people that this is a time frame issue too, though. If what I think is going to happen and the consumer kind of hits the skids, banks are probably also going to hit the skids. However, that's the entry point. So if we see some stress in financials, in banks, I think that financials and other sectors like materials, industrials are what probably lead us back out of this, because as we know, the sectors that lead you into a peak in the market are rarely the ones that lead you out of a trough.
Well, sometimes first in is first out.
So she just brought up a good point there, but it's a very misguided point, what she just brought out there. And I think this is important. Everybody understands that that's watching this video right now, right? She talks about if the consumer hits the skids, as she put it, right? And, basically kind of like the market tanks, everything gets bad, the banks tank, right? That's your opportunity to buy. Okay, yes, true. But there's going to be way better opportunities if that was a situation. If the S&P, let's say, fell 20%, I know she's pretty bearish on the market. Let's say S&P falls 20%, right? Because consumer, recession, blah, 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 it all happens. It all plays out, okay? And S&P 500 goes down another 20% from here. It's 30%, whatever, okay? I can tell you there's going to be way better opportunities than buying Bank of America, Goldman Sachs, Morgan Stanley, any of those. Will those be money-making opportunities? Absolutely. But will those be even remotely close to the best opportunities you're going to get in the market? No. Okay. And so that's kind of where you got to say, where are the best places to put my money? I can tell you in that situation, the best place to put your money is not those big banks. There's going to be far better opportunities in the market. Okay. So that's just one of those points that I'm like, she's right, but she's also kind of it's a misguided point in my personal opinion.
But I'm wondering, Joe, how you think about, it's beyond the consumer, just about the economy in general, if we have a recession or not. As long as you have those questions hanging over bank stocks, what does it mean? Because if you have in the back of your mind to be worried about credit risk, should something get dislocated, you know where I'm going.
So I'm more concerned with the S&P just sitting here and continuing to wrestle with 4,000. Because for Morgan Stanley, for Goldman Sachs, and even in the case of Bank of America, JP Morgan, and Citi, trading revenue has been resilient, surprisingly strong at times in 2022, and that's supported the valuation. If we're going to be in an environment where we're really consolidating for the S&P, I'm concerned having ownership of Morgan Stanley, looking potentially at some point to purchase Goldman Sachs, and having the other three banks under consideration.
Boom. Great point. Great point. These Wall Street banks, man, they make so much money when there's mad volatility in the market, when everybody's freaking out, panicking, buying, selling, the market going all over the place, VIX spiking higher. That's when those folks make a ton of money. This sort of market, worst case scenario for them, because it's still uncertain. So a lot of the IPO money's not coming in right now, right? Because no one's doing an IPO because it's still such an uncertain environment. So they're not, that business is just completely dead right now, right? And on top of that, you don't have a lot of trading activity. It's a bad situation for all these folks on Wall Street right now. Next one, consumers edging closer to a breaking point.
Consumer spending activity suggests big trouble ahead. Rebecca Patterson is a former chief investment strategist at hedge fund Bridgewater Associates. She's out with a CNBC op-ed today. The calm before the storm. These three drivers will dictate the landing ahead for the U.S. economy. Rebecca, welcome. Great to see you. Great to have you on Fast again. Before we get to the three drivers, Wile E. Coyote moment. That doesn't sound like a good kind of moment for the U.S. consumer, and that's exactly what you think is going to happen.
I think that's where we're headed. It's interesting. And Target was a perfect example of the dynamic. Their earnings for right now, fine. Their expectations soft, and the consumer right now, fine. But where are we going? And so when you think about what's holding up the consumer right now, they spent down all their excess savings from the pandemic, fiscal transfers. And what struck me and what really prompted me to write this piece was the Federal Reserve report that came out recently that showed that in the fourth quarter, we saw between mortgages and credit cards, $400 billion going on to total household debt balances. That was the biggest increase on a quarter that we've seen in 20 years. And credit card interest rates today are up to 20.
Numbers are all relative, man. Like that's just a, 2 points. Okay. First point is that's just like these numbers are, it's like the government saying, we got a new, we're going to spend $500 billion, right? And the government says that, it's like, okay, big deal, right? I don't know, 50 years ago, maybe that meant something, but nowadays when they're spending trillions on this and that, it's like big deal, okay? And so you kind of expect those numbers to jump bigger and bigger over time, right? Doesn't mean it's not a concern, but that's like the way, like 20 years from now, I can tell you, if consumers add $400 billion to their balance sheets in liabilities or assets, whatever way you want to take it, right? In liabilities, I can tell you it's not going to be a big number. It's like, okay, big deal, okay? So just naturally over time, as the numbers get bigger, as the economy gets bigger, as GDP gets bigger, as assets get bigger, as everything gets bigger, right? The numbers will be bigger. Second point I got to make before I let her go any further, because I think this is important you understand about her, okay, is she obviously former Bridgewater person, right? If you're at Bridgewater, you're around Ray Dalio. If you know Ray Dalio, you know Ray Dalio's opinion that we're going through, a certain market cycle of a deleveraging, right? He calls it, hopefully a beautiful deleveraging. And so he's kind of more bearish in this time period we're in right now, okay? And so naturally, if you are around a Ray Dalio like that, right, you're going to likely respect him on a high level, and you're going to respect his opinion. And if he believes a market's a certain way, you're going to believe it's a certain way. And I think that's just important we all understand that before we kind of go any further around kind of her mindset and where that's at, right?
Percent, which is also a multi-decade high. And I look at this and say, okay, the consumer keeps piling on credit as long as the job market's tight and they have incomes. But what if companies start to pull back? Or what if consumers just say, maybe I need to be a bit more cautious? And on the latter, we saw that today in the Conference Board February Consumer Confidence Report. It showed current conditions strong, consumer expectations the weakest we've seen since last July. And so we're not there yet. That's what makes this tough. But you're starting to see more and more dots, more and more markers that are telling us that the consumer is going to get more cautious. And when they do, think about the linkages. If the consumer's spending less, it's less revenue for a company. Companies are making less money. Guess what they're going to start doing? Paring back CapEx, paring back hiring. Greater layoffs means there we go and we get the earnings hit. So I do think we're looking at equity market downside later this year. And I would be watching that interplay between the consumer, companies in the labor market, and of course the Fed and those borrowing costs.
I call it the dominoes falling the wrong way in the economy.
Rebecca, it's Tim. Great to see you again on the show. And I guess you're talking about the divergence that is going on between where rates are and where stocks are. And how are you explaining this? Because we're sitting here scratching our heads watching a 65 basis point move on where we've gone in the bond market, pick, the short end or long end. And yet this divergence between where stocks are is very difficult, especially at a time we're finally getting that pullback in EPS, certainly operating EPS following U.S. GAAP and reported EPS. So what do you say to that?
Well, I think there's probably a lot of reasons playing into this, but two that I'm really focused on. One is that the consumer is so strong, and I think there is still a lot of hope out there that we can have a very soft landing, that companies, rather than letting workers go, will simply reduce the job openings and more participation potentially. All those things together could pull wage inflation down, allow the Fed to pause, and the consumer can keep going for some time. I think the other factor that might be leading equities to look through this a little bit is the fact that interest rates are still expected to fall starting at the end of this year. Now, the market has increased its pricing for a terminal Fed funds rate for this year, and now people are talking about 5.5%, even 6% for a terminal Fed funds rate by mid-year. But the market is still pricing that we get rate cuts, significant rate cuts next year. And for the Fed to actually ease, you need to get a lot of economic weakness. You need to get inflation not only to target, but probably below. If those things happen, then I think stocks are going to come down. So I think the market's trying to say, oh, the Fed's going to pivot soon. That'll help us. This is just short term. And maybe we get a soft landing. But I think both of those scenarios, while not impossible, are pretty low probabilities.
It's fair.
So, Rebecca, you're free from the shackles of Bridgewater and you're doing your own thing. So now you can actually talk individual stocks and trading and all that stuff that we used to talk to you about a long time ago. How do you put this to work? Directionally, are you, Are you bearish on the markets, or what sorts of trades would you put on to back this thesis?
I mean, right now, we're still benefiting from the China reopening. We're benefiting from incredibly low gas prices relative to what was feared, which is helping Europe's economy and the U.S. consumer. As I said, that's 2/3 of our economy is still kicking strong. So in the immediate future, things look okay. The problem is that as I look 3 months, 6 months ahead, and it's hard to know the timing, I see more and more signs that this thing is going to fizzle out. And so the question is, when do you start taking some chips off the table? I think it depends on your risk appetite. It depends on your time frame, what kind of trader you are. Personally, I'm taking more of a 3 or 6 month view and saying, you know what, I'm going to start building in some of my portfolio insurance now. The T-bill, 6 month T-bill today got to 5.14%. That's the highest it's been since 2007. If I can make 5% plus on 6 month cash, that doesn't seem like a terrible opportunity cost. Are stocks really going to go up 10%, 20% in the next 6 months? I kind of doubt it. So doing a little bit of that, taking some chips off the table, and then within your equity exposure, look, I know the defensives have not had a great year start. Utilities are down, 6-7% year to date, but starting to take that weakness and use it to build in, again, just a modest incremental slice of portfolio insurance over the next couple of months. So when the party does end, when you have the Wile E. Coyote moment, you're not falling off the cliff. You find a nice cloud to land in.
Rebecca, great to have you on the show. Hope you'll come visit us here on the desk soon. Rebecca Patterson.
Absolutely.
Interesting. Ray Dalio, what do you think about market timing? Because your former Bridgewater chief investment strategist is clearly a market timer. That's the thing that bugs me with a lot of these folks, right? They preach about not trying to time the market, but then did you just hear her? She's talking about the next 3 to 6 months. I'm going to park some money over here. I'm going to do this. They're traders. And it's just like, it's mind-blowing to me, right? It's mind-blowing to me, that they can't just have a longer-term outlook. They're trying to play this and play that and get in, get out. It's just, it is what it is. Dan Niles, let's hear what happens here. I'm going to try to keep my composure.
So if the Fed's going to 6%, do you still
Destroy
see
him.
more pain for the equity markets, which is not quite priced for that?
Yeah, absolutely. And I think the reason we see it going to 6% is, don't forget, the biggest consumer commodities on the planet has been shut down for 3 years. And China has exited zero COVID in December. And so from our perspective, you look at inflation and what it's done, it's come down a lot driven by commodity prices during this period of time. With China opening up, we actually have our portfolio.
Wrong right off the bat. There's such a false assumption, like China's been shut down for 3 years and putting it like that. Oh, really? Oh, okay. Who's been making all the iPhones? How are the iPhones getting to the containers? Who's making all the Teslas then, right? Tesla makes more vehicles in China than pretty much anywhere else in the world. How are they making all those Teslas, right? How are we getting the shirts? How are we getting the clothing? How are we getting all this stuff? Who do you think's making all this? Has China really been shut down if really we've been getting all our supplies that we always get? No, that's not the reality. Certain segments, travel, those sorts of things have been shut down. But to just say, China's been completely shut down, they haven't been using anything, is the most inaccurate piece and statement you could possibly make, dude. Come on, man, wake up. But that's what these people like to say. They like to say, they've just been shut down. Nothing's been happening in China. And it's like, dude, if China was really shut down, we would be so screwed right now. S&P 500 earnings would be negative.
In a lot of commodity-driven names in copper, aluminum, oil, et cetera. And I think what you're going to see is by mid-year, commodity prices starting to really pick up as China starts to consume again. And then don't forget, their consumers are also sitting on about $1.2 trillion in excess savings that they're going to start to spend now that they've been unlocked. So that's why we see inflation kind of
starting to consume again, like they haven't been producing everything that we possibly get in the United States as well as Europe gets. They haven't been consuming food and everything else you possibly need. What are we talking about here, man?
Strong. And then obviously you've got twice as many job openings as people unemployed. That's going to keep wages strong. And that's 55% of PCE. That drives the Fed to 6% versus expectations of some rate cut that, people had been thinking up until now.
So let's talk about how you're positioning for that setup. Dan, I looked to you and was wondering if you were in, sexy tech stock, some name we haven't heard of or that's been hammered. And I see the first one on your list is a 3-month T-bill. Why?
Well, as you opened up with, right, our portfolio is a mixture of offense and defense because our belief is that as you get into the back half of the year, the positives of you've got $1.5 trillion in U.S. consumer excess savings, that's going to be depleted by the back half. You're going to have inflation pick up. I think you're going to see new lows for the S&P 500 as you get into the back half of the year. So in that scenario, you want to have a combination of offense and defense. Remember, when we started last year, a 3-month T-bill, I think, yielded about 3 basis points. Now you can get about 4.8% on that. And so you want to have some cash on hand, especially if you think the S&P is a good shot of getting to 3,000, which is kind of where we think it'll end up ultimately. And we have, healthcare in there as well, the XLV, for the same reason, to give you some defense. But we also have some offense in there. Meta, obviously, that's done pretty well this year. We think it's going to keep getting better based on some of the Advantage Plus tools that they have coming, which is AI-powered advertising.
Dan Niles doesn't understand. It's just like, I sometimes get frustrated with people that have experience and they just aren't even seeing the most obvious things, right? He's talking about he's got all this money in treasuries, right? What did the last lady just talk about? She's got a bunch of money in treasuries right now. Everybody's got a bunch of money in treasuries, right? Which means they're all waiting to put that money in the market because they believe they're of the thought process that S&P 500 can go down to whatever number they're making up in their head. 3,600, 3,400, 3,200, 3,000, 2,800, whatever number they magically make up. His number was 3,000. I think it's going to 3,000, okay? So what do you think is going to happen if the market starts to sell off in any significant way? Well, as it hits people's numbers, they're going to take their money out of treasuries. They're going to funnel it into the market, which puts somewhat of a floor under it, right? Think about these things sometimes. And so he's like hoping this. Dude, I hope, some houses in Vegas go down 40% money so I can buy some more real estate investment properties. But just because I'm hoping something doesn't mean it's going to happen. Okay, you see an asset for a great price, you've got to take advantage of that. And at the end of the day, there's a million other people that if the home in Vegas goes down 20%, they're ready to buy, or 10% or 15%, right? It's like, why is LA real estate always hold up well other than good weather and just being LA, right? One of the other reasons is there's so many real estate investors in LA. LA's always been a great market for kind of, appreciation over time. So you've got a lot of people in that market with a lot of money that if they see prices go down just 5%, 7%, 3%, they're ready to buy. So it puts such a floor under LA real estate. It's what happens, right? So nonetheless, I just think that's a misguided, that's something that so many of these folks are missing right now, including Dan Niles.
I think that's going to do pretty well. And then we own a Japanese bank, MUFG. We think that's going to do really well as Japan gets away from yield control. So we've got this mixture of offense and defense sitting in the portfolio. And as I said earlier, we have commodity stocks that'll do well with the China reopening.
Yeah, your Meta pick is interesting, Dan, because you're basically saying it's too cheap at 16 times. They've already
these
taken
guys that try to predict these commodities, such a joke, man. I just watched so many people, all these Wall Streeters go on throughout the summer and saying oil was going to keep going up, keep going up, keep going up, keep going up, and all oil did was go down, down, down. Then it was natural gas is going to keep going up, keep going up. This is what they were saying in the fall time now. And then natural gas just started going down and down and down as we got closer to winter, and as winter started, it just went down. And obviously, I think natural gas is 2 something right now. So these guys trying to predict these commodities is such a silly thing. And if you want to talk about markets that could be potentially heavily manipulated, commodities.
And expenses getting under control, traction on reels. But aren't there other companies, maybe not at that size, which have gotten cheap and which have at least taken the bull by the horns on expense control and even CapEx control?
Well, remember, the last piece is valuation. So you've got Meta trading at about 15 times. The S&P is trading at 18 times. And don't forget, they lost about $10 billion of revenues when Apple put in their privacy changes. So that's, they're lapping that, and their new tools are really helping them with efficiency for advertising. So you put that together, and you have to consider the valuation piece of this, because just because something's down 90% doesn't mean it's cheap. It just means it's down 90%. And if it's unprofitable, you've got a bigger problem in there, in that if the market gets worse because the Fed has to keep raising rates, those companies are going to run out of money. So down 90% doesn't mean it can't go down another 100%. So I think that's the last piece that people have sort of ignored, because for the last 13 years, every time the market looked like it was going to stall out, the Fed was able to stimulate the market, cut rates further. And so that kept the party alive. Well, that's because you didn't have any inflation. You got high inflation right now. So the Fed's got a completely different playbook, and people are still going back to the playbook of the last 13 years.
No, it's a great point, and that lost Fed put is so interesting. But I got to wonder, if in fact you're right about S&P getting to 3K, how does the Fed commentary sound at that moment?
Well, here's the thing, right? They've been very clear about this. They need to get inflation under control for the long term. And if you go back to the 1970s, we have this playbook. And the Feds looked at that and said, the Fed prematurely cut 3 separate times, including Volcker, which people forget about. And then inflation took off again. And then the Fed had to raise rates even higher. And that was really painful and punishing. And so this Fed does not want to make the same mistake. And so we've got some charts on danniles.com that show, how many more jobs there are relative to people. And if you just big picture think about what happened to the U.S. economy when we got unlocked, right? Inflation really took off. So imagine what happens when the biggest consumer of lots of different commodities in the world, China, they've been locked up for 3 years. They're getting unlocked, and they're stimulating their economy because they don't want social unrest, which we saw in December. So that's the piece you got to remember as we get further into this year. That's going to put a lot of pressure on the Fed to keep hiking. That's why we think 6% is where you get to, and you get no rate rate cuts this year because of that.
Fair points by Dan Niles there at the end. Fair. I'll leave it there. So, I appreciate everybody joining me as always. I kept it peaceful there at the end. Thank you, everybody. Subscribe to the channel. Thank you, everybody that supports the channel on Patreon, and that is the pinned comment down there. Appreciate y'all. Much love, and have a great day.